Yeah. Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion. He's the CEO and founder of Flying V, our digital marketing partner. Robb, how was your week?
Weekend was great, Gary. Caught a lot of the Masters tournament, so that was exciting. Scotty Scheffler, I don't know if you're a golf fan at all, but that was a good watch. And yeah, just kind of hung out and ready to get our Monday off with these five things.
Yeah, so I'm not really a golf fan, but I always said I would play golf if they made one of two rule changes. One, if they changed it from number of strokes to how long it took, right? It really should be 18 times 400-meter sprints, or alternatively, if they made it a full contact game.
Okay, both of those are interesting. I think my only stipulation would be that we also can reduce it from 18 holes to 14 as well, just because 18 holes is way too many.
Especially if there's tackling.
No doubt. Gary, we've got a great episode of this week's Five Things. We're talking a lot of oil. We have another special guest on the show today, circling back to the Bank of Japan. We're talking commercial real estate as well and what that market's looking like, and it's not necessarily getting better. But Gary, I'll turn it to you to start to introduce our first guest,
All
or
right,
our only
terrific.
guest this time. Last week we had two guests, just one
Ex
guest this time.
Yes, right, but we have a good one. I want to introduce Tracy Shuchart, who heads up Hill Tower Resource Advisors, one of my all-time favorite energy experts, also Shy Girl on Twitter or X, whatever we're calling it today. Tracy, how are you?
Great. It's great to be here. Thank you so
Yeah.
much.
Thank you. Are you a golf fan?
No.
All right, so that's the two of us together who didn't watch golf.
I'm outnumbered.
All
Pretty
right.
much.
All right. So just for before we get started talking about energy, for everybody watching this, if you're a huge golf fan, remember to put in the comments that you're mad at Tracy and me. And, just make sure you comment that you watch golf and you're angry that we don't.
That's totally fine.
Yeah. All right. So, Tracy, let's get started. Let's talk about the SPR, the headline we've got we're doing point number 3 out of order here. The commodity trader in chief missed the big trade. The White House sold off half of the SPR, the Strategic Petroleum Reserve. They sold it down to levels that we last saw 40 years ago when the population of the United States was about 1/3 lower than it is right now. They did that a couple of years ago to lower the price of gas going into the midterm elections. It worked. The price of gas came down and the Democrats outperformed expectations. And then the White House came out and they said, we'll refill the SPR when crude gets down into the 70s. And I believe, you can correct me if I'm wrong, I think WTI, West Texas Intermediate, actually hit 69 and the White House did not refill. Now we've got WTI, West Texas Intermediate, trading in the mid to high 80s. I think high 80s now, right?
Right.
And they haven't replenished. They just canceled an intended purchase of 3 million barrels. What are your thoughts?
So, well, I've said this for a while. I said they are not going to meaningfully replenish the SPR, especially not during an election year, because that would take more barrels off the market and further exacerbate oil prices. And obviously that prediction was correct as we saw them again cancel this latest 3 million barrel SPR, which should not be shocking to the market. Now what we heard today is, people are speculating that they may further drain the SPR because we have a serious issue with Venezuela right now. We have the Venezuela 6-month oil sanction sanction relief, I should say, is expiring on April 18th. This means that we're going to have less heavy crude oil. This is going to be a huge problem because we're already seeing we have Mexico reducing their exports to the United States of heavy crude oil. And then we have the Trans Mountain Extension pipeline in Canada opening up, which will further move heavy crude oil from Canada to the US to Canada to Asia. And so US is kind of in a pickle right now, for lack of a better word. We did see the US meet secretly, I use this in quotes, last week with Venezuela. asking them basically, can you please have free and fair elections again? Maduro said, yeah, okay. And I don't see any situation with the 3 days we have left for this contract to expire that Maduro's going to suddenly have a change of heart since he hasn't in the last 6 months. So that being said, the US has a couple choices here. Either they let it expire quietly and don't bring that much attention to the market so that oil prices don't spike on some sort of headline, or they cave and they extend the sanctions relief. So yeah, again, the US is kind of in a pickle right now when we're talking about this. And so I bring this all up because really what this has to do is with the SPR, because the United States wanted to fill the SPR. Now this is going to make it more difficult to the SPR. And because of this Venezuela situation, people are now speculating that maybe they drain the SPR more. Now, what do I think about this? Well, as I've said since day one, this is a terrible, terrible, terrible idea. All right. So if you think about this logically, if you drain the SPR and some geopolitical or weather related, i.e., hurricane crisis arrives, and don't forget, we had back when Katrina happened, we had to tap the SPR because it was Louisiana, it was made oil hub, and we had to tap the SPR. So thank goodness we had oil there. So if you do not have this reserve, that makes US supply very vulnerable. And so, yes, I have heard the argument from people. The opposite side of this argument, which I will address, is that, shale is our SPR. Why do we need an SPR? We have so much in reserves in the ground, we can just produce it. Well, great. That's great. But good luck on that with declining tier 1 acreage, declining duck inventory, declining rigs, higher gas to oil ratio in the wells that we are producing right now, which means the wells are getting gassier. We're getting more light stuff that can only be used for chemical processing, not gasoline or other distillates that we need. We have energy companies focused on capital preservation. They don't want to spend more money on new wells. In fact, they're, buying acreage, as we see in these M&As right now, instead of producing more or taking their capital and expanding that to produce more. They're buying that. And then you also have an 18 to 20 month lead time if you actually want to get more production online. So if we have an emergency, we have a huge issue right now. Shale is not our SPR by any stretch of the imagination. Could you imagine if we had a serious problem like we did in the 1970s with Iran? And yes, we are a major exporter now. We're not such a big, but just for example, hypothetically speaking, and you needed to wait 18 to 24 months to get this stuff out of the ground, it's just not a logical way to go about doing things. And that's if these companies are even willing to do that. And so there's a whole host of problems. And the end result is the SPR is a national security issue, in my opinion.
Right.
Period. End of story. And that's what I have to say about the SPR.
Yeah, it's funny the way you phrased it, because I've been writing for the last 2 years that this administration is rolling the dice every year going into hurricane season, right? Every year they're rolling the dice that a hurricane doesn't take down production in the Gulf and end up in a situation where we really do need the SPR. And this also highlights, one of the things we've written about a lot is that this administration doesn't have a coherent energy policy. When you're trying to limit oil production, but you're running on hopefully lower gas prices, that's going to be a problem. Finally, great comment on the situation with Maduro. If I were him, though, and this administration said to me, "Hey, listen, any chance we could get you to run free and fair elections?" My response might have been, sure, no problem. Just send us a few of those Dominion voting machines you guys use.
Right? Well, exactly. And of course of course that didn't happen. All he wanted was us to say, we're going to relieve sanctions for 6 months. He's like, yeah, do whatever you want. Wink.
Yeah, right. There are no consequences, but clearly this is going to be an issue because I think we can expect further production and transportation issues coming out of Iran in the future because we just had the weekend that we did, which I know everybody here has followed closely. Let's move on to item number 4, and we'll go back and cover the other ones later, but we've got Tracy right now. This is the one that Tracy sent in for the week, titled Global Oil Inventories Are Declining, and highlighting the huge decrease in global oil inventories at the same time that there are the same production issues that she was talking about, that Tracy, that you were just talking about in the last segment. What are your thoughts on that?
So, here's once again, we have EIA revising everything, which is not surprising because they've done so since 2021. We've had huge revisions on demand, upward demand, and huge revisions on supply, downward supply. So, the EIA has missed their mark over and over again, literally consistently since 2021. And the problem here is that we're running into issues right now. And the only way that we can, the fastest fix, okay, so let me backtrack a little bit, sorry. But we have to look at what shale production is right now, lower 48. I think that we'll have, I think what conventional, I think we're going to be okay. I think that production is going to remain fine. That would be Alaska and the Gulf of Mexico. But if we look at shale, I think 2023, we hit the peak. And it had nothing to do with Biden. It had nothing to do with anybody who was president at the time.
Right.
Anybody could have been president. It had nothing to do with who was president at the time. We had a lot of smaller guys trying to produce as much as they can to be eaten up by the larger guys. We've seen these big M&A deals, right? Everybody wanted to look attractive to get swallowed up by the majors. And so, a lot of people, a lot of mid to smaller tier companies made a lot of money over the last 2 years being eaten up, and they produced a lot to make their company look more attractive. And so that's one of the reasons that we saw US production go up. But I think that we really have hit the peak in 2023, at least for the foreseeable future, unless something changes in the industry. I think we hit the peak in 2023. In fact, we just had EIA come back. They revised November and December down from 13.3 million barrels a day to 12.5 million barrels a day, which is a huge revision down, right? For November, December, and January. And it doesn't look like that is going to change anytime soon. So this is what I expect. I expect that we kind of have to hit our peak. We've hit probably max M&A. We'll probably see some more consolidation within the industry, absolutely. But most of the big deals are done now. And I think, and now a lot of that tier 1 acreage has been burned out. We've burned through our duck wells, which are drilled but uncompleted wells. That inventory is kind of your backup inventory. Nobody's spending capital on building out new capacity. They're buying new capacity. And so I just don't foresee how shale production can grow much more at this juncture unless we have a complete change in what's going on in the industry. And so what that brings us to is, so how do we resolve this? Well, what could change everything right now is that OPEC that has had cuts, in addition to voluntary cuts, most of that shouldered by Saudi Arabia, of a tune to about 1 million barrels a day. Now, if they change their mind and decide to get rid of the voluntary cuts, and they're going to go 1 million barrels per day after this June 1st meeting, 2024, that's the next meeting, then that would change the whole supply demand balance. At this point, I don't see any reason why they would currently change their trajectory on how they are doing business right now, because they have a limited spare capacity. They were going to build out spare capacity, but that was going to cost a lot of money. And Saudi Arabia has really aggressive plans right now to make that country a world-renowned tourist destination, as well as some other really big projects they have going on, like NEOM, and things of that nature, to kind of build out Saudi Arabia. To almost like a Dubai, right? I think they kind of want to be like a Dubai. And so, right now, they scaled back their plans on building out their capacity, because that was going to cost billions of dollars. And they're pouring that money in elsewhere, and they're making a lot of money with Brent at, $85, $90 a barrel. That's where they need it to be. So they know that if they decide to pour another 1 million barrels a day, get rid of the voluntary cuts on June 1st, that's going to obviously probably lower the price of oil by $5-7 at least right away. And they can't do that right now. They're perfectly happy with oil prices where they are. And I'm giving in, let's give and take, $5 for geopolitical issues. Let's factor that in. But still, again, $80 to $90 a barrel is the sweet spot for them. They like it. It's in their budget. They're making money. They're happy with it. And so I just don't see a reason for them to change their policy at this point. Perhaps later in the year, yeah, but June 1st, no.
That's, it's a great point. I think people often underestimate or don't realize that the depletion schedule for shale is much faster than it is for, like a traditional well.
Oh, absolutely.
And that's, that's a key thing. And, the US has been the leader in shale oil for a while, but those aren't long reserves. They deplete really, really quickly. The last question I've got for you is Deep Knowledge Investing has had huge positions in oil and energy since late 2021. So the fourth quarter of 21, they worked out great for us. We've made a lot of money in them. The current supply and demand imbalances that you were just highlighting, what do you think that means for our oil positions?
I think I'm still a huge fan of oil or energy in general. I don't think that demand is going away anytime soon, right? Especially if we look at emerging markets, particularly India and some African nations. And that's not going away anytime soon. It doesn't matter if Europe is in a self-devolving, spiraling deindustrialization pit. Oil demand's not going away anytime soon. Again, we've had OPEC and EIA and IEA all this past week come out, revised everything up, said we were wrong. Demand's been much stronger than we thought it was going to be for 2023, because it was their, kind of their Q4 results, right? And said, demand's much higher than we thought it was going to be. The imbalance is much higher than we thought it was going to be. And literally all three reports said that. And so I think, energy, as you know, is a little bit squirrely, never goes in a straight line, has its ups and downs. But over the long term, I think it's going to outperform and do really well.
All right. Sounds great. Obviously, next time we have you on, we're going to be talking energy and uranium. And for all the different oil and energy organizations that missed their estimates, we'll just send them the same people here who are doing our employment numbers and see if they can get that sorted out. That's a regular theme here on the five things, talking about how off the employment numbers are.
Yeah,
and how
last numbers are, yeah.
Yeah, exactly. So Tracy, thank you so much. Always great talking with you. How can people find you for people who want to know more about energy from a real expert?
So our website is www.hilltowerresourceadvisors.com. I'm also on Twitter. That's my only social media account, which is at Shy Girl. It's because I used to work at CVOT and I was from Chicago, so it was Chicago Girl, and so that's why it's Shy Girl, because everybody asked me. And that was 2009, so I couldn't change it. It's already, everybody knows me there. I also am doing a joint project with Damp Spring with Andy Constant, and that's www.dampspring.com, where I am doing a commodities collaboration with their existing portfolio.
All right, sounds great. We'll put links to your social media, to Hill Tower, in the description, so people can just click and find you there. Thanks so much for joining us, Tracy.
Thank you, guys.
Thanks,
All right.
Tracy.
Talk to you soon.
Great stuff there.
Yeah. Yeah.
Any additional thoughts on that, Gary? One question I had,
Yeah.
with elections coming up, I mean, what is the White House going to do? Obviously, they're wanting to keep gas prices as low as possible, but doesn't seem like seems like a very volatile situation going on, especially now after this past weekend as well.
They're going to gamble. There is no way in the world they start to replenish the SPR. We'd be talking about 300 million barrels. They're not going to do that. They can't handle going into an election with gas at $5 a gallon. So they're not going to do it. And it worked for them last time. They got lucky, but they're rolling the dice that we don't have a hurricane come through the Gulf and take down production in Texas or Louisiana. And that stuff usually happens when it happens in September, sometimes October, right before elections. Listen, I have two minds on this. One, I understand that, politics is a contact sport, and every politician from either party will use any and all means that they can to gain re-election. And, right or wrong, that's the way the game is played. And I understand that. The thing that concerns me about it, and Tracy alluded to this, but it's a national security issue. And, we potentially could have a gigantic problem. And Tracy's right. When people say, oh, well, but it's fine. We produce oil. Yeah, but in an emergency situation, that production can be taken down. We've needed the SPR as a strategic. It's the word strategic is in the title for a reason. And so, there are national security issues surrounding this. There are safety issues. I get that politics is a contact sport. I get that everyone from both parties will do all they can for their own interests, but I really prefer that they not do that with national security issues.
No doubt. Good stuff. Thanks for getting Tracy on. We'll be sure to include links to her website, social media channel as well. So be sure to check her out, give her a follow. Before we move on to the rest of the five things, this week, again, Unicus Research. Thank you for sponsoring this week's version. Unicus Research is a short, biased, independent investigative research firm. They perform in-depth research on their ideas, including speaking with their industry sources, which gives their clients an investment edge on recommendation. Their ideas have generated more than 70% ROI on the downside for their clients. Be sure to call Deep Knowledge Investing if you're interested. 15% discount off of their financial newsletter will be complimentary. Moving into our five things for this week, Gary, we're talking CPI right out of the gate. Thing number one, the CPI comes in high and is still understated.
Yeah, so the March CPI, that stands for Consumer Price Index, and that is typically the gauge that people look at when we talk about inflation. Now, is it really a correct and proper measure of inflation? No, not even close, but that's how we view it. That came in for March at 3.5%. Now, is that a big deal? Yeah, it really is. And the reason is because last month was 3.2%. Now we're back up to 3.5%. that kills the disinflation story. And this is something we've talked about a lot. For people who don't love or remember their high school calculus, disinflation is a change in the rate of change. It's basically saying we still have inflation, but less inflation than we had before. We have increasing prices, but prices are increasing at a slower rate. Well, when your CPI goes from 3.2% to 3.5%, that's not disinflation, that's increasing inflation. The other thing is it was higher than expectations, and even worse, the monthly number was 0.4%. And this is something that we talk about a lot. So people might say, well, wait a minute, do we really care about 0.4%? Right? If something, if something costs $100, do you really care if it's another 40 cents? Well, no, but the issue is that's a month over month number. And when you annualize 0.4% across 12 months, it annualizes to 4.9%. And when your inflation target is 2%, which I will keep saying this no matter how angry people get, that 2% inflation target is 2% too high. But when you're trying to target 2% and you're annualizing at 4.9%, that's a giant problem. The core number, as usual, was just really sticky and flat. So you had the regular number, the regular CPI coming up, the core flat. And then on top of all of that, I continue to express skepticism on how understated the CPI is. Just as my favorite example, last month's report claims that food inflation was 2.2%. Again, I ask this question every month. I'm going to ask it again. If you're listening to this and your grocery bill is up only 2% in the last month, please message me, comment, let me know, because you will be the first. I've been asking this question for 2 years, and I have not found a single person who will tell me, yeah, my grocery bill is only up 2%. Every number, every answer I've ever gotten on that question since I've been asking it for the last 2 years ranges somewhere between 20% and 50%. So, people aren't even close. If your grocery bill is up only 2%, put it in the comments. I'd love to read it and find out what in the world you guys are buying.
Yeah, and then Gary and I will pack our bags and head out your way immediately. So,
Yeah.
Gary, with this trend, what are we seeing on the horizon for rate cuts rest of the year?
So, Rob, that's a great question, and this is an area where I'm actually really proud of the work Deep Knowledge Investing has done on this topic. Rolling into 2024, when we were at the end of 23, people talked about the projections for the year, and the general consensus was 6 rate cuts for a total of 1.5%, starting in January, and if not in January, maybe March. And at the time, Deep Knowledge Investing said, absolutely not a chance, no way, it's not going to happen. Coming into this last inflation report, there was an expectation that we would get 3 rate cuts for 75 basis points. That's 0.75%. Starting, maybe June. People were kind of 50-50 on June. Again, that's a situation where, you look back at prior video editions of the 5 things, we've said, we're taking the under. We don't believe that number either. Now the conversation is somewhere between 0 and 2 cuts starting in September. The issue with that for the incumbents in Washington is that's going to be too late to provide stimulus for them to run on. So, if you're pro-incumbent, this is bad news for you. If you're anti-incumbent and want to see more turnover in Washington, this is good news for you. So whichever side you're on, you can, you have your rooting interests on this. At the end of the day, I suspect we're not going to get rate cuts this year. If we do, maybe one of them. It's difficult to predict, so much so, and we're going to have charts on this out in our April letter, which we'll have out later this month. But, our intern, Andrew Brown, and I have done the analysis on this, and the Federal Reserve is horrible at predicting future interest rates, right? We've got charts on this. And so the Fed, they give you their projections. They have no idea. But Rob, there's one last point on this that's worth making, which is just a month or 2 ago, had anybody said the Fed might raise rates this year, people would have said, you're completely crazy. It's not going to happen. Well, guess what? Now there are serious people who are, good economists saying there's a real possibility the Fed could raise this year. Now, I don't think that's likely. And I don't think that's likely simply for the reason that if Powell does that, the howls out of people claiming that it's an unexpected political move will be enough to tarnish his legacy. And I think he's somebody who cares a lot about his legacy. You could argue that's a good thing or a bad thing, but I think that's just who he is. And so, just a month ago, people would have said that's crazy, but now there are serious people saying we could get rate hikes this year.
Interesting. Moving to thing number 2, Gary, we're talking Bank of Japan. The Bank of Japan is being forced to act.
Yeah. So Deep Knowledge Investing started speaking and writing about this issue a year and a half ago. And so for people who are just coming to it now, we're starting to see a lot of activity on Twitter or X, people talking about it, discovering the issue. I'm really glad to see it. Our subscribers knew about this 18 months ago. What's happened is the Bank of Japan is an extreme version of what's happened in the United States. So here in the US, we kept interest rates at or around zero for well over a decade and blew up a gigantic debt bubble. And that has caused, some serious problems, which we're experiencing right now as inflation, but we're going to have a budget crisis. What Japan did was they actually kept their version of the Fed funds rate below zero for 9 years. They had negative interest rates. And so what that does is it creates something called the carry trade. And we'll talk about it more later. But what traders were doing were they were shorting Japanese government bonds at around zero, and they were buying US government bonds that might have been yielding 2, 3, 4, 5%, depending on when they were putting this on, and capturing that spread. It was called the carry trade. Well, what happened was you had lots of people selling the yen, buying the dollar, and that was because the Bank of Japan had kept interest rates so low for so long. If we go back just a couple of years ago, I've got the chart right here. January of 2021, it was 102 yen to the dollar. As of today, it hit 154 yen to the dollar. That's a disaster. We've talked about this before. For people who, are angry and upset like we are about higher prices here in the US, about an inflation problem, about paying high prices at the pump when we go fill up our cars. Try to imagine doing that when your currency is slid 50% against the dollar. And just a reminder, oil tends to be priced in dollars. That's why they call it the petrodollar. So this is a gigantic problem for Japan. We talked about this 2 or 3 weeks ago, Rob. The Bank of Japan made a big deal of saying we're going to go from negative rates to positive rates and then raise the reference rate to somewhere between 0 and 0.1%. So
Right.
Congratulations, Japan. You're now at 0.05%, which puts you right where the, US checking accounts were a couple of years ago. And, they did that to protect the yen, and the market basically laughed at them. And I think when they did that, it was something like 150, 151 yen to the dollar. Now we're at 154. The yen is it's sliding on a weekly basis, and they're going to need to act to deal with this. And it's a huge problem for them.
With Gary, the yen sitting at that 154 mark, probably likely to see BOJ sell off US treasuries, effectively selling dollar for yen. What's the effect here?
Yeah, so let's talk about why they have to do that, Rob. And that's a great question. What is happening is the Bank of Japan should raise interest rates. The reason they can't is in Japan, the debt to GDP number is in the neighborhood of 260%. So if they raise interest rates, Japan has a huge amount of debt. That's going to increase their interest expense. It's going to blow out their budget. Well, how will the Bank of Japan deal with it? They'll print more yen. Well, what happens when you print more yen? You end up with more inflation, which is a fancy way of saying that the purchasing power of your currency is falling. And what happens then is you need to raise interest rates again, which causes a budget problem. They print more yen, get more inflation. This is why we call it a debt death spiral. Just run a few rounds of that and the whole thing falls apart. So what the Bank of Japan is likely to do next to protect the yen is they own trillions of dollars of US Treasury bonds. They're going to sell the US Treasury bonds and then use that to buy their own bonds or buy the yen. And that will reverse some of the slide in the yen. That's a gigantic problem for the United States. We had a Treasury auction last week with a 3 basis point tail. That means that the auction was undersubscribed and people ended up paying less for our bonds than they normally would. And you could ask, hey, is a 3 basis point tail a big deal? Yeah, it's actually a really big number in a US Treasury auction. It signals a giant lack of demand. I believe it's the second or third worst Treasury auction we've had in the last 10 years. I'm not 100% positive, but the point is a 3 basis point tail is really bad. And so the Japanese would be selling into a weak Treasury market. What that does would be depress the price of US Treasuries and increase the borrowing costs for the US government. Well, what happens then? We have higher borrowing costs that increase our interest expense, and then we have to go through the same machinations that we were talking about Japan, where our interest expense goes up. We have to print more dollars. That creates more inflation, forcing the Federal Reserve to raise interest rates, and again, running that cycle again. And so we've talked before about how the US Federal Reserve is trapped. The Bank of Japan is trapped more. The next thing they're going to do is sell our bonds. And that's going to be a huge problem for the market here. One other thing to add for people like us who are primarily focused on the equity markets, when bond yields go up, that tends to be bad for the equity markets because the discount rate, we discount future earnings, future cash flows for the companies that we own at a faster rate. And so, enough selling by the Bank of Japan in the US Treasury market could actually bring down the S&P 500 or the NASDAQ.
Interesting analysis there, Gary. Thank you for that. Moving to our final point of this week's 5 things, we're jumping back into the commercial real estate market. It's not looking like it's getting any better. Point number 5, thing number 5, Gary, the problems in commercial real estate are getting worse.
We've been talking about commercial real estate, I think, every week for the last month.
Yeah, definitely.
And probably will continue doing so for a while. It's a big problem. It's a big problem for 2 reasons. One is because valuations in the commercial real estate space are down a huge amount. Valuations in the housing market continue to be stratospheric to the point where it's very difficult for young couples in particular, young people in particular, to buy houses. So this is a big part of our economy. But the reason commercial real estate is a big deal is because it's highly leveraged. These assets have large amounts of debt associated with them. So at some level, the equity can be wiped out and banks can end up having the keys tossed back to them and being told, yeah, we can't pay the mortgage anymore. Congratulations, you now own distressed real estate, which if you're a bank is the last thing you want to do because they're leveraged. And this is basically the commercial real estate version of what we saw in 2008 in the US housing market. So the thing that we're seeing in a number of big cities, and we're talking now about the office market, Rob, I assume you guys, how often are you guys in the office? Or do you have a lot of people? You have people working from all over the world, don't you?
Yeah, we're remote. I may be a little bit of a creature of habit, right? I'm in daily, but I can tell you most often than not, not everyone that is in this office is here daily. But I'd say, yeah, 50% maybe.
Yeah. I work from all over the world. You and I have filmed versions of the 5 things from Nicaragua, from Thailand, from the Philippines. So I work from everywhere. When I have, new people, when I have interns come on, they say, can I come into the office? No. Do I have to come into the office? There's no office. We're not doing this. And so there are enough people like you and me who are saying, I don't care where you are, just get the work done.
Right.
And it's putting pressure on the commercial office space. Now, what some of these properties are doing, or the landlords are doing, is they're doing something that's technically legal but highly misleading. So what they're doing is they're saying, their tenant comes to them and says, I don't know if I want to renew my lease. It's $10,000 a month. And, the market is really weak and maybe I don't want to renew, or if I do, maybe I'll only renew, maybe I'd give you 6 or 7 or 8,000 a month, but not 10,000 a month. And what happens is the landlord says, wait a minute, no, I can't have the rent that I show, the headline rent, go down because that'll make the banks think that I'm running a distressed property. So they say, listen, I need you to sign a contract that says you'll keep paying $10,000 a month, but in exchange for you signing that, I'll give you a free month of rent, or maybe I'll give you 2 free months of rent, or maybe I'll give you 2 free months of rent and we'll pay for a build out, or we'll pay to renovate your space. We'll pay for the stuff you were going to pay, right? But we can't have the headline rent change. And so, it's technically legal, but what they're doing is fraud adjacent, right? It's highly misleading because, you know, it's like saying, hey, Rob, pay me $10,000 so I can tell people you paid me $10,000, but here's, you know, $2,000 or $3,000 in cash back under the table that we won't report to anyone, you know, and then I get to report a big number and you get to pay the lower amount. And so we're seeing that in the commercial office space. I would also give a round of applause to the Wall Street Journal. They've covered this issue really well and in great detail. It's been really good reporting by them on this topic.
What would the domino be that falls that does get people to wake up in the commercial real estate space to what is actually happening? I mean, I'm sure a lot of the big players obviously already know the situation, right? But when you kind of have the blindfold being covered over everybody else's eyes, I mean, what is that moment, that catalyst that will make everybody wake up and say, oh, wow, the commercial real estate space is, in what you're calling it, pretty bad shape?
So the issue with what these property owners are doing is it helps the numbers that they report, but it doesn't help the cash flow statement, right? So if they're telling everyone I'm collecting 10,000 in rent, but they're paying out $2,000, $3,000, $4,000 under the table, then their real effective rent is, you know, $6,000, $7,000, $8,000.
Right.
And so, you know, it makes the income numbers or the reported numbers to the bank look good, but it's not great for your cash flow statement. And so, you know, what will happen at some point is, you know, enough people say, I'm not renewing at any price, or I'm not renewing even if you give me a free month or two. And then some other people say, yeah, you know, I want 2 free months and a build out. And at some point, the business is just no longer profitable. And when that happens, you know, the landlords can just say to the bank, yeah, I'm not paying the mortgage anymore. Right. And hand the keys back. And that is something that happens. And it's something that people forget at times. You don't have to pay your mortgage, but you won't own the property. And there are people who make the decision. They say, you know what, this property is worth less than the mortgage. It's no longer my problem. It's going to be the bank's problem. Now, is that an ethical thing to do? No, but it is 100% legal. The contract you sign doesn't say you have to pay. The contract you sign says if you don't pay, then we'll take possession of the building. Well, if you have a building with $100 million mortgage, and you think the property is worth $60 million, right? And you have cash flow that will support $60 million, you might just hand the keys back to the bank and say, it's yours. You own it. I'm going to walk away. And then when that happens, you end up with a giant real estate crisis. And as a reminder, it's not just the real estate property owners that are leveraged, it's the banks, and you end up with bank stress, bank problems, depending on how bad it is, a banking crisis. I'm not saying, you know, we're going to have a banking crisis this year, but I've heard credible stories that the people in Washington, D.C. are already preparing another commercial property bailout, another bank bailout. They bail out the banks on the commercial property stuff. If that were to happen, I would expect, I hope this doesn't happen, but I would expect some level of domestic unrest. People would be justifiably angry at the government bailing out the banks again, bailing out the property owners again. People were angry in 2008. I think if it happens again, you know, just you know, a decade and a half later, I'd be angry about it. Wouldn't you be angry if the government were handing more money to these corporations and saying you don't have to worry about risk control, you don't have to pay the price, the American taxpayer will do it? I'd be angry if that happens. And I suspect that a lot of other Americans will be angry as well.
I think you're spot on with that, Gary. Gary, this concludes this week's 5 Things. Again, we want to thank our sponsor, Unicus Research. Be sure to check them out online as well as in the written 5 Things for links to their organization, research reports, etc. As always, thank you so much for watching this week's 5 Things. Be sure to head to our website, deepknowledgeinvesting.com. Sign up for a free subscription. That'll allow you to get access to posts that do come out. Some things may be gated for our premium subscribers, in which we're giving them current recommendations, buys, sells, and other premium content. But as always, we'd love if you consider any type of subscription to Deep Knowledge Investing, or be sure to follow Gary, Deep Knowledge Investing, social media accounts online as well. Gary, any closing thoughts from you?
Yeah, just for everyone who's watching this, we get it. Like things are rough right now. We're talking about the CPI and higher prices. We're talking about energy and higher gas prices. You know, we're talking about commercial real estate problems. You know, keep your head down, keep working hard. There are things that you can do to protect yourself, to protect your portfolio. I spend all day trying to find ways to help our subscribers protect their net worth, to protect their retirement, to be able to grow, to be able to afford a house. That's what we do all day. You know, you want our help, we're here for you. If not, go to someone else. That's cool, but don't lose hope. Stick, you know, keep with it. And for the people who are watching, thanks so much for taking the time. We know your time is really valuable. We appreciate you spending it with us. I also want to just give a special thank you. We had a lot of people commenting this week, and I really appreciate it. Thanks for engaging. For those of you who said, hey, great program, we really love it. I like this or that, terrific. And for those of you who don't like what we're doing, that's cool too. I'm interested in your opinion. Just tell me why. Give me give me your view on it. We engage with the people who disagree, and maybe we'll all learn something as well. So thanks for your time. And Rob, thanks for doing this with me. I always love doing the 5 things with you.
Of course, Gary. Yeah, it's always a pleasure. And I echo the same notes to everybody that watches us, listens in. Really appreciate your support. Thanks so much, Gary.
All right. Thanks, everyone.